Thank you. Welcome to Dorset Pension Fund Committee meeting of the 18th of March 2025. My name is Councillor Andy Canning. I'm the chair of the committee and member for Dorchester West. Our first item agenda, any other apologies?
We've had no apologies from any committee members. We have had an apology from Aidan Dunn, the council's chief financial officer. Today.
Okay. Good. That's good. There's so many people here. Yeah. Minutes of our last meeting held, in which case I shall start. No takers of interest. Public participation, we've had no questions received. So we move on to item 5, questions from councillors. I was asked the other day about what the arrangements are for councillors submitting questions formally to the committee, and you have to do so a week beforehand. If you do that in writing, that gives us then time to write the answers up. So that's useful to know, I think. Urgent items. I don't have any urgent items.
No urgent items.
No. Okay. And on to item 7, the independent auditor's statement and report. Sean, I believe you wanted to tell us a bit about it.
Yes. Have we got Jackson online? Yeah.
I am, yes, Sean.
Thanks, Jason. So just a quick point of clarity, just on, and obviously many of you will have known we've had some challenges around the audit, both for the council and for the pension fund, which relate to the prior years and effectively were backstopped. That was whilst we were working with Deloitte. So we just wanted to make clear that the reports you're talking about today are for 23-24, and we've worked, I think with Dave and the team, because we worked really effectively with Jackson and his colleagues that supported the pension fund audit, and we're really pleased with the level of assurance we've been able to provide today. So perhaps just setting the scene as a reminder of there's some clear water between the relationship and the dynamic with Deloitte and the new relationship with Grant Thornton. I just thought that'd be helpful just for that clarity.
Yes, I think we've all found it very deeply frustrating about the slow state of progress with the older accounts, and it's good to be moving on. Jackson, did you want to introduce yourself and make any comments?
Absolutely, yeah. Thanks, Sharon. Thanks very much for allowing me to join first the committee and secondly remotely this afternoon. So as Sean alluded to, so my name's Jackson Murray. I'm the key audit partner, the appointed auditor to both Dorset Council and Dorset Pension Fund, and we began our responsibilities for the 23-24 financial year, responsibilities which we concluded last month in advance of the national backstop date of the 28th of February. So there's a number of documents on today's agenda under this item, and a number of those are ours. So I was briefly going to talk through those, Chair, and then invite any comments or questions on what I say.
Okay.
The first document is actually the most formal, I suppose. So from page 11 of today's committee pack, that is the audit opinion that sits in the council as the administering authority's set of accounts, with the pension fund accounts included within that set of accounts. So that's the formal opinion wording. I'm going to spend most of my time on our findings report, which begins on page 15 of the agenda pack. And this is the formal reporting that went through to the council's audit and governance committee, which met on the 24th of February. The report goes to audit and governance, as they are what is known as those charged with governance, or in terms of the scheme of delegation, they hold that role. And our role as external auditors is report our findings to those charged with governance. However, it is really important that yourselves as a pension fund committee also have sight of these findings. I'll be pleased to hear I'm not intending to go through page by page, but I'm going to pick out the salient points. I think to do so, I'm going to start on page 18 of the pack, and it's a page that's entitled Headlines. So on that, we reflect, and as Sean said, we were new auditors in 23-24, which itself creates some challenges and some additional work as we begin to get to know you, your systems, processes, controls, etc. There were also prior year audits still ongoing. So the pension fund team were dealing with pretty unprecedented situation of having multiple years of audits open, and an even further unenviable situation of having two sets of auditors asking them questions on various years. So reflection would be it probably took longer in our first year to undertake the audit than I know we're all hoping it will in future years. However, I think the outcome that Sean alluded to was we have begun to rebuild that assurance. So committee will be aware that the 22-23 financial year was backstopped by Deloitte. Backstopped is a terminology that probably Sean and I hear every day, but I'm conscious some of the committee members may not hear. So long story short, there are lots of delays in local audit. Government enacted legislation that effectively sets out a backstop date by which, if your work is not complete, you draw a line, report that you've not been able to conclude, and move on to the next financial year. So that first backstop date for Deloitte was December 2024. And so the pension fund for 22-23 got a disclaimed opinion, effectively saying, Deloitte saying we cannot provide assurance on this set of accounts. That creates a challenge for me as incoming auditor, because I then don't have assurance on the starting point of my audit. So whilst myself and the team have managed to undertake a lot of audit work and begin to rebuild assurance on those in-year transactions, the balance is at the 31st of March 24, I can't get assurance that the starting point for those accounts was correct. And so the result of that is another disclaimed audit opinion for 23-24. The pension fund is not alone in that. There's near 1,000 sets of accounts that are receiving these sorts of opinions. The national guidance sets out that this won't be a one-year issue. So where prior years were backstopped, coming into 23-24, government and relevant regulatory bodies would expect that 23-24 would be backstopped with a disclaimer, as has been done. 24-5 will have some form of qualification because the comparative information within the financial statements will still be the same. We won't have the assurance over that. And then moving forward into the third year, then it's likely that we will have rebuilt assurance. There may be an except for opinion because of the opening balances in the comparators. And then we move into a normal cycle, one hopes, of providing appropriate audit assurance and an unmodified audit opinion. So I thought it was helpful to set that context. What we've been able to do is a significant amount of work, and this report sets out the findings from that significant amount of work. Bearing in mind that ultimately reading the black and white of the opinion, which is that first document I referred to, it will say we're disclaiming. And in an audit world, in normal circumstances, a disclaimer is quite a considerable thing. I'm going to skip through some of the pages and then just invite any comments or questions at the end, Chair. So page 21 of the agenda pack. As auditors, we don't audit to the pound or to the penny. We set materiality thresholds, and a materiality threshold is effectively what could change the users of accounts opinion of a set of financial statements, effectively in a summary. So materiality overall for the financial statements was set at 39.3 million. In a normal world, if there was an error or an uncertainty above that amount, and there was a disagreement between ourselves and management, and management declined to adjust the financial statements, we may then get into a situation where we would be talking about a qualification. Our audit didn't identify any material misstatements or changes to the financial statements, which gives us, and it should give you some assurance that those draft accounts were appropriately presented and produced. We then have trivial matters just under 2 million. So any error or uncertainty above that amount, corrected or uncorrected, would appear within this formal report. Rest assured, if there were errors or uncertainties below that threshold identified as part of the audit, we would discuss those with management, but we're not required to formally report those through this report. And then, because within the pension fund financial statements, clearly the net asset statement is a significant statement. It includes some very significant balances. The fund account would be somewhat dwarfed by some of those investment balances. So we set a separate materiality level for the fund account of £11.5 million. So those are the materiality and triviality thresholds that we undertook the audit to. And it's important to understand those in terms of what gets reported next. So over the page, pages 22 and 23 set out the 3 presumed risks that any auditor considers as part of an audit of a public sector financial statements. So there's a risk that there's fraudulent either expenditure or revenue recognition. We rebutted both of those risks as we were able to under the standards due to control environment and also the nature of income and expenditure. Page 23 sets out the non-rebuttable risk of management override of controls. This exists at any audit entity, so whether that's public sector or not. This is really interested in estimates, judgments, areas such as journal controls and journal entries to the financial ledger. The key areas we pull out here are related to journals, but also due or related to system elements. So in an ideal world, an external auditor would see a ledger journal being prepared by one user and a second user with some form of segregation of duties approving that journal. Now, we appreciate it within public sector entities, the amount of journals that are posted on a daily, let alone weekly or yearly basis are considerable. So that would take considerable resource. So the pension fund and the council, like many other bodies that we work with, work to an approval threshold. And that is that any journal below 50k can be posted directly onto the ledger without any authorization. We reflect that there is therefore a risk of either error or fraud of journals below that level, somebody posting them without another user reviewing them. I think the important thing that we also note on this page, however, is from our testing, we didn't identify any issues or adjustments or require any further reporting. However, there is that theoretical risk. And so we report a risk that these things could happen or a deficiency in our view in the control environment, which the Audit and Governance Committee noted as part of their consideration of this report. We also undertook detailed IT audit work. So IT audit colleagues considered the control environment within the pension fund and council's financial systems and identified some control points to be raised in respect of the SAP system in particular. And those were reported separately to Audit and Governance as well. Over the page, or over the next 2 pages rather, 24 and 25, these set out the other 2 significant risks that we identified. So the valuation of level 3 investments, level 3 on the fair value hierarchy, so the hard to value investments, and also the directly held property. So both very large numbers. Valuation is dependent on estimation techniques, judgment, no material or significant findings on either. For the level 3 investments, the main point that we reported were due to timing differences, so slight difference in valuation based on information that the pension fund had when it closed and produced its financial statements, May, June 24, and the information available to us as auditors up to 2025 February. So that's just a case of we will always have some timing differences, especially for the hard to value elements that may be published accounts since draft accounts produced. The financial statements weren't updated for that. As you can see, the value was just under 3 million. If you recall, materiality was significantly higher than that. We were satisfied that management's approach was to not adjust the financial statements for that value. Over the page, directly held property, no issues with the valuation themselves. One point we reflected was there weren't formal terms of engagement, which we would normally see and expect between the valuer and the pension fund, so made a recommendation to do so in future years. We also refer to the triennial valuation on page 26. You may wonder why, given we're talking in 2025 about the 22 valuation. We rely on that work, and we do that work every triennial valuation. As the predecessor auditor hadn't completed that work, we undertook that work this year to allow us to continue to rely on that work and use that work for 23-24. No issues there to bring to your attention. The next few pages go through a number of areas that we are required to report to those charged with governance. There's nothing in the pages that I wish to bring to your attention and no significant findings. I'll touch briefly on page 34 of the agenda. We undertook one, what is classed as non-audit piece of work. So as auditor of the pension fund, I get assurance requests from auditors of other admitted bodies, the main ones being the other local government bodies, so the police, BCP, Bournemouth Christchurch Pool, and Dorset Council. That work is audit related work. It's included within the scale fee that's set for us. We can also get other admitted bodies auditors writing to us requesting assurances. We had one such letter from the auditors of United Learning Trust. We responded to that. That is classed as non-audit work. There is a small charge for that, as you can see, £1,100. And we set out why we do not believe that creates a threat to our independence as external auditor. Finally, then, within the appendices themselves, so pages 38 and 39 of the agenda pack set out the 6 control recommendations that we raised along with any management response to them. I've already noted the one we assessed as high around journal authorization, and I've talked through that already. We didn't follow up any prior year recommendations from the predecessor auditor, given they didn't report their findings till December 24. There was insufficient time, A, for management to take action, and for B, for us to then report on those through to February. So we will consider those as part of future work. And then pages 41 and 42 set out some of the changes and disclosure amendments. There's not a significant number there to give committee some context. And the only one that actually made an impact on main financial statements was a small reclassification between current assets and current liabilities of just over 300,000. So again, with those materiality levels, nothing considerable. The final one was the unadjusted point, which I talked through with the timing difference of level 3 investment valuations there set out on page 43. Final comments then. So page 44 sets out the proposed final fees for the audit. We set out the various elements of those. Our contract is with public sector audit appointments, as is the councils and hence the pension funds. Any fee variations are required to be considered and approved by them. So as it stands, we have shared proposed fees with PSAA, but we await for them to consider and determine whether those fees are appropriate or not, but we disclose what we have shared with PSAA. The rest of the report then goes through some of the formal wording. So we have the draft audit opinion, which we talked about in the first appendix. The other element that we're required to provide is a consistency opinion, which goes into the pension fund annual report, which effectively says the replicated financial statements within the pension fund annual report are consistent with those in the council's financial statement that we have audited. We issued that report at the same time as the audit opinion and concluded that they were consistent. I said I was going to try and be brief. I'm conscious I've already taken up 20 minutes of the committee's agenda time. So I think, Chair, I'm going to stop talking at that point and ask for any comments or questions.
Thank you. I think the most important thing is that everything you said sounds reassuring, and so it doesn't worry anything too much. Are there any particular questions that anybody has? No? Okay, well, thank you. Oh, sorry. There's a round.
Rather than a question, I think there's one slight typo. Sorry, actually, it was a really useful presentation, actually, and I did find, going through the report, there's a lot of useful stuff in there, and I acknowledge the sort of difficulty because of the prior years issues. I think it's page 28 of Appendix D, audit adjustments. My attention was drawn to whether things were adjusted, but when a lot of them have got tick boxes, and there's one there which has got a cross against it and wasn't adjusted. But I think in the last line, it talks about a difference of 4641k and didn't adjust it due to that difference being immaterial. I think it's £4,641 rather than 4641k. Otherwise it's saying 4.6 million is immaterial, so we didn't adjust it. But I don't know if you can see that in your report.
I've just pulled that up through you, Chair. Apologies. So I think it is 4.6 million. I'd need to go back to the detail, but I do believe it is 4.6 million. But taking into account our materiality is 39.3 million, that would then be the reason for our comment that it wasn't material. But I can check back through the detail on the audit file and come back.
The difference between the figures there, the 3.5 million and 3,521,000, 3,517,000, and it said the difference is 4,641,000, which isn't. I think it's.
I see what you mean. Yeah. You are correct.
Yeah. So sorry.
Okay. Thank you very much.
But actually, I think it's really useful to have all this detail. Obviously, the Audit and Governance Committee will pay the sort of most attention to the detailed assessment of it, but it is useful for us to have for us.
Any other questions? No?
Just simply one of clarification. The fees, is this purely for the pension fund?
Yes.
Separate from the other one?
Yeah, so there's a similar report for the council, and the council's fees will be reported within that one. Yes.
Thank you.
Okay, great. Well, thank you very much for that. Hopefully, we will get to the end of this problem, long running problem now. We're getting out. So, thank you.
Thank you very much.
Then on to item 8, the LGPS pooling update. We're very happy to be joined by Laura Chappell this afternoon. So, Laura, do you want to introduce yourself and give us a presentation?
Fantastic, thank you. So, Laura Chappell, I have been CEO of the Brunel Pension Partnership for the last 6 years. I was there from inception with Steve. Been here through this interesting period that we're experiencing at the moment. I do want to apologise for not being there at your last meeting, actually. I was summoned to see the previous pension minister, not like the week before, I think it was. And the same nearly happened today. I was offered 2 slots with the new pensions minister, Torsten Bell. One was today and one was tomorrow. So I'm going tomorrow now. So apologies for that. I think what we're going to do is probably do more of a Q&A just to make in a conversation rather than a monologue for me. So I think Steve's going to ask the questions and I will do my best to answer them. But please do interrupt with questions. I think I want this to be interactive more than me just talking at you.
Good. Well, thank you, Laura, for coming down. It's great to see you and to answer the questions of the committee. So we've got a series of questions that have been sent round to the committee. They're numbered. I'll propose to sort of summarise them and then obviously chip in. The questions fall into 4 categories, really: performance, responsible investment, pooling and the future of pooling, all the change that is going on there, and then just a quick update on the Chief Investment Officer. So the kind of headline on performance is, and I will perhaps read verbatim the first question. Do the CEO and board acknowledge the persistent underperformance of many portfolios, especially listed equity? And what are you doing to address this? And I'll just give a bit of background to that, which is that at committee meetings for the past 2 or 3 years, the 3 years that I've been here, we spent a lot of time looking at the Brunel performance numbers and focusing on that and talking to Brunel and hearing explanations of performance. So it's taken a lot of our headspace. We acknowledge the headwinds, we acknowledge the RI approach. What is your kind of response to this?
So I think we very much agree with you, actually. So we've got a new chair. So Sally Bridgeland just started. She took up the position, I think, October last year. And also, obviously, we've got the new CIO coming in at some point soon too. So the first thing Sally asked was to the board was, are we good investors? Are we actually good at what we do? Because, in the same way that you would ask a baker if they make good bread. And I think the answer came back, yes, in many ways, especially in relation to responsible investing. But as Steve said, investing through climate change at the moment has been very, very hard. Active management in general has been very hard across the whole industry. So you set the specs of the portfolios, you do the asset allocation, but we pick the managers. And we've been underweight in things like energy and materials value over this time because of the responsible investment and climate change slants that we've got. I think the test for me will really come now that the performance of the Mag 7 is starting to drop off. If we don't start to pick up performance, we can't keep saying, oh, we're waiting for the Goldilocks conditions to come. So it's crunch time for us, really. So for me, we're not waiting for the new CIO to arrive. The board has initiated a review of a number of portfolios, and we expect the new CIO to want to do a stock take as well when they arrive, and not least because in the new proposed world from the government, we'll be advising you on the strategic asset allocation. So actually we'll be owning rather a lot more risk than we were owning previously. So it's likely that we will want to do that in the longer term. I don't think we can wait to the end of this cycle because nobody really knows when it's going to end. So I think really crunch time for us. The board have acknowledged that.
Okay.
We're going to work through it.
That's a really kind of interesting response. So can you share with us which portfolios those are that you?
I probably don't want to do it in public
Okay.
because
Okay.
you heard about some of it this morning at your training session, I
Yes.
think. Yes, I don't want to talk about individual portfolios and managers at
Okay.
the moment.
Okay, so the subsidiary questions that we had on the list of questions, I'm just to make sure those have been answered.
Yes.
So one of them was, is there appropriate challenge from the board to the investment team? I mean, you sort of addressed with that with what you've just said.
Yes, Sally's an actuary by training. She's also been a consultant, as you know, Steve. So the two of you will probably share quite similar views on performance. So, you know, I think Sally's come in with a different view of the world.
Yeah.
As the chair, and she's putting in some really good challenge.
Yeah.
So
So what do you think is the? Sorry, can I just? I mean, could you just follow up with a kind of supplementary question? So you said now it's crunch time. So now I'm just trying to think. Now, do we interpret that as 2025? Do we interpret that as 2 years? What do how are you and the board thinking about what that is in terms of crunch time?
So I think it needs to be over this year. But I will caveat that with we don't know what Trump is up to at the moment. So that's I hate to use the word it's creating headwinds, but it's not a headwind, it's a hurricane. If I'm going to be really honest. So I think there's a bit of sitting back and saying, right, what does responsible investing actually mean to us? And I think we'll come on to that in a minute, and I'll answer some of your other questions.
Okay, so let's, because the two things are interrelated.
Yes.
Performance and responsible investing
Exactly.
are interrelated. So the question was: is Brunel's responsible investment policy helping or hindering investment performance, and what real world impacts is the policy having? So there are two dimensions to that. There's the headwinds, and then, well, are we making any difference anyway?
Yes. Yeah. Exactly.
Yeah, do you want to?
Yes, I think it's important to remember that climate is only one aspect of responsible investing, right? You wouldn't want to be an irresponsible investor these days. Let's be really clear about that. But climate change has been a struggle, but as a long-term pension fund, you also need to manage your long-term systemic risks, and climate change is still one of those. So no matter what is happening out there in the big wide world, and it is quite difficult at the moment, climate change is still a long-term risk that we need to look at. So I would suggest that over the next couple of years, you look towards private markets more to get that real world impact, because actually that's where we really see that coming through. So if you move away from just looking at climate, you get your social impact through affordable housing, you get jobs created through green stuff in the UK. You've already invested locally through, I think it's Wessex Gardens you're in. That's having a huge impact locally from our perspective. You're not in there? You're not in there. Oh, it's got Wessex in the title. Oh dear, that's a shame. But we've got numerous examples in private markets where we have impact. And I think that where you're going to see the biggest bang for your buck in the future. I'm not sure it's within the active portfolios anymore. I think that world is changing. So we have pivoted the RI policy to focus a little bit more and balance out climate with other risks. So loss of biodiversity and nature, really important. And that's going to grow in stature over the next couple of years. Doesn't matter what Trump does, that's still there. And the other thing that we've been looking at is kind of social and human rights within the portfolios and trying to invest for more social housing, that type of activity, particularly in the UK, which aligns with the government's UK growth agenda. So we've got numerous case studies in private markets, and you can see them on our internet site. And this is really where I think we're going to have more impact going forward.
Okay. Can I just sort of quote to you
Yes.
Dorset's investment strategy statement,
Yes.
or statement of investment policy, which I think would probably be very similar to your own. But it's just to remind you, I think you know this anyway, or you do know this anyway. The fund has a fiduciary duty to seek to obtain the best financial return that it can for its scheme members and their employees, and all other considerations are secondary. However, the fund is mindful of its responsibilities as a long-term shareholder and believes that in the long term, better financial returns will be generated by investing in companies and assets that contribute to the long-term sustainable success of the global economy and society. And it says actually the fund endorses and supports Brunel's approach to responsible investment. But the reason I picked that up is just because all of the considerations are secondary. At the end of the day, the committee feels the pressure of underperformance versus the strategic benchmark and the impact that will have, should that go on for compound periods of 3, 6, 9 years, on tax on employers and the contributions they will have to make to the scheme. So there is definitely a real world impact here as well. My kind of challenge around private markets is a little bit, I mean, it's very, a lot of people think that private markets they have historically performed quite well, but it's also quite an untransparent market. It has very high fees associated with it. And, we'll certainly, with Brunel taking more responsibility for strategic asset allocation going forward, you will, unless we put constraints around that, in terms of how much you can have in private markets, you may do things that we perhaps don't agree with or don't want you to do. But it will be your call. But it will be, it might, where I'm going with this a little bit in terms of this concern is that it might make that lack of transparency might make it difficult to find out how well you're doing from a performance point of view. Any acknowledgements of that?
No, and I think that's well acknowledged within private markets, and that's one of the things that we're working really hard to get more transparency there. So I think personally, I can say in the 8 years that we've been doing this, our reporting has improved within private markets probably fourfold. So actually, we've got much more visibility into what we're investing in. And in fact, actually, just talking to our head of private markets yesterday, we're now starting to see some of those assets bear fruit that we invested in cycle 1. So actually, we can see the proof of what we've got starting to come through now. So if I was sitting here 2 years ago, I'd have agreed with Steve, and we'd be in a different situation. I think what I also want to say about the asset allocation piece, even in the new world, we're only advising you. You get the final say as the pension committee still. So if you don't like what we're suggesting, you get to say, try again, please, Brunel. So I think that's really important to know. There's a lot of worry out there right now that we'll be taking over the world, and that's just not true. So I want to offer a bit of reassurance there. Okay.
I just think we need to be, I will advise the committee to be cautious on any increase in private markets because because of some of the things I mentioned, high fees, lack of transparency, leverage used to achieve the returns. There's still quite a bit of dispute in the investment world about whether private markets actually is better than investing in listed markets. But I can understand the answer to the previous question, which is where you said, well, we can achieve more about investing responsibly via private markets. I agree, I completely get that, because you can build a wind farm or you can whatever, rather than disinvest from an oil company. Those shares then go to a hedge fund manager who doesn't care about the economy, about the environment.
Yes.
I kind of, which is why you don't have a disinvestment.
And that feeds very nicely into your active passive debate as well, actually, is where do you go with that in the future, given in the active world, we're now seeing companies repealing their net zero targets. How do we manage something actively where we can't manage to targets anymore? What happens next? So I think, you know, that's a decision for you guys as committee still at the moment. And I can't advise you on that, but I think it's a really interesting discussion that pension funds are having right now.
Okay. I suppose the other thing, but the other thing I want to caution a little bit with private markets is obviously you mentioned that you're meeting Torsten Bell tomorrow. It's like the government's favourite thing is private markets and what the pools are going to do to energise the UK economy. Obviously, we all want the UK economy to be energised, but we don't want to suffer subpar returns as a consequence of that.
100% not. Interesting enough, I know Aidan Dunn isn't here today, but him and I have been having some conversations about local investment in Dorset. And my overriding concern to him is it's actually got to be an investable opportunity for us. We can't just throw money at something. So he said he was disappointed, but also heartened to hear that. I think he was wearing two hats at that point. But I think you're right, you know, councils are looking, we're going to see more with the devolved authorities coming down the line. And in our region, there's not as many as there are up north. And at the moment, because most of the money is going up north and it's not coming down to us. So I think that'll be, watch this space. But I take your point, Steve.
Please feel free to kind of other people to ask questions, but I'll go with the flow of the written questions if that's sort of okay. 2.5 was about how you're managing the increased demands from and different expectations of your 10 clients in relation to RI ESG matters. What would you like to happen? So I can see, just even from a conversation I had with an officer at one of the environment agents actually the other day, at a conference, where you know there's a wide spread of RI expectations. I can imagine that's a problem for now. How do you reconcile? How are you going to reconcile that in the future?
Yeah, I think so. There's two things here. The first is we've got a wide enough spread of funds at the moment to accommodate everybody. If the government pushes us down a route where we're forced to consolidate some of those, that may well be a problem for RI beliefs going forward. So at the moment we're good with that. I think what I see and hear is from the teams is actually we're getting more and more information requests for things that pension committees are interested in, and we're having to produce the data on things like defence holdings, Israel, Palestine, you know, more climate change stuff than we ever envisaged that we would have to look at. So that's the increase for me. So at the moment, I'm less worried about the divergence from an investment perspective because I think we can accommodate that still, unless something drastic happens. But I am worried about the extra requests that we're getting. That is resource intensive.
And presumably what you were saying earlier on biodiversity and social impact, which are also measurable, have to be measurable things. That also sounds to me like that's a kind of whole bunch of work and data that you are not resourceful, basically.
Yeah, exactly. Local investing within portfolios, that's another one.
Yeah.
You know, we're having to tag things to be able to pull it out so that you can see what we've got locally. So yeah, that is quite resource intensive.
Okay. I'm good. So I'm good. Yeah.
Just to come back on one of the points you raised there about the sort of ad hoc requests and questions that you get about whether it be Israel, Palestine, or defence companies, that sort of thing. You said it's more than you'd anticipated. Do you see that changing? Because personally, I think as a sort of democratic organisation, a public democratic organisation, and we get questions from public, questions from councillors on our sort of wider authorities. And for me, it's one of those costs of operating in an open and democratic public body, that those questions will be raised and need answers to be made to them. And I guess the change over the years is that people have become a little bit more engaged in these issues, and campaign groups have become more engaged in these issues, and actually are wanting to pose those questions and seek those answers. So personally, I don't see that as changing in the future. In some ways, it's a good, I accept it's a resource intensive thing for Brunel, but in some ways I think it's a good thing in terms of the sort of openness and transparency to the public.
And I don't think there's anyone in the room that doesn't not care about where their pension's being invested. So, and actually social media these days makes it easier to be able to see those things. So, and easier to ask those questions. So no, I don't see any drop off in that coming at any point in the near future. I don't think. I think you're right.
I think we might suggest that we move on towards the government consultation on Fit for Future. But before we do that, perhaps if there are any, like we've talked about performance, and we've talked about responsible investing and the interaction of that with performance. Are there any?
Yeah, I hear the word headwinds. I hate the word headwinds. Headwinds affect everybody equally, and yet we consistently underperform against benchmark. How long is this going to go on for? What are we doing to change the outcome that we currently are seeing?
Yeah, so I think aside from the things that I've already talked about, you have the gift of that change within what you do, because you guys help us set the portfolio specifications. You guys decide which funds you're going to go into. So if you vote with your feet and say we don't want that, then actually over time that then decreases our impact within a certain area. So I think it's a combination of both of us working together to get that outcome. And as I said to Steve, we need to see a change this year, and it's really important that we do. So those reviews that we're doing at the moment should produce an outcome that, now that we know that the Mag 7 are starting to drop off, we have no excuse anymore.
I mean, if I may push back just a little, I've only been on this committee for 6 months, 7 months, however long it is, so I don't have context. But I've looked at the data and I'm seeing the same funds underperform consistently quarter after quarter after quarter. Now, I look at that as being, I don't want to get into individuals or name funds or anything like that. When I see departments underperform, change happens quicker rather than slower, is what I'm looking at. Are we going to see a more robust management of the funds themselves coming forward?
Will it be more robust? I think there'll be more challenge around it. I don't want to say robust, because we're long-term investors and we've got to think long-term here. And what I don't want to do is to make a change off the back of poor performance at the wrong time. So that's really key for us as investors. But I 100% take your point. It isn't good enough, right? And that's completely where we are right now.
Are there any restrictions that we've given you historically which impede you from performing better? Something that we've changed that we can change it and look at again to improve performance? Seeing as you're throwing it back to us in that way, I'm just going to throw that back to you and ask you the question bluntly. So.
Yeah, and we're working through those now. So you had your workshop this morning. Hopefully you heard this morning about one of the changes that we're looking to do, I hope. Don't know.
To which one?
Yeah, I'll fill you in on that later. But I think it's within our gift as a whole, because all 10 need to agree to any changes.
Yeah,
it can't just be us saying, right, we want to change this. That's not within our gift. We've got to agree it with every single participant, not just within that fund, but also within Brunel. And that is one of the hard bits about pooling, is that we all have to come together to agree something, and it can't just be one on its own. So yes, there may well be.
So it's in our hands, but it's not.
Yeah, it's in the hands of 10
It's-
plus us. So
which
it's
is
11.
which is an issue because it's a
Yes.
coordination issue. But I
Yeah.
mean, you know,
We're 1 of 10, aren't we?
we all at
Yeah.
10. Everybody has
Yeah.
to collaboration is going to be essential to the future success of the LGPS. It has to be. You know, I kind of I find it frustrating a little bit. I'm always trying to get attention on the smart beta. There's a smart beta fund which
Yes.
you manage. It's a passive fund. Dorset are the only people that hold it. It's one of the best performing funds in the Brunel universe, and we're
no
the
one
only
else
people who
wants
own it.
Yeah.
And trying to get the other 9 to be interested in it, they're not interested at the moment.
Yeah.
So it kind of that's an example of a kind of frustration. It was.
You did say that that was heavily fossil fuel
It is,
based.
yeah,
Yeah.
yeah.
No.
Well, it's not heavily, but it's over the benchmark.
Yes, sort of a relatively practical question in terms of investing in private markets and, for example, renewable energy within Dorset. So offshore or onshore wind, a huge project that pension fund could invest in and has a return. Like, how do we actually start making that happen?
Yeah, so so what we've done is you guys have started with an idea, right? What we've done is to then introduce you to our fund managers who are, for this purpose, Greencoat, so that they can walk through what an investable opportunity might look like in the future. We're probably not going to invest at the start, but we may well come in later. So I think what you've got is some great ideas at the moment, and we're helping you work through those. But hopefully there'll be an investable opportunity at the end of it, but I can't guarantee anything. What we're really good at is connection, collaboration, making sure that the dots are joined so that when we do get to an investable opportunity, we might be able to take it. But again, that will be your decision. It won't be my decision within that space.
Yeah, you'll be able to decide whether it's a safe decision.
Yes, yeah,
yeah. But we need to sort of almost, I envisage that if we're wanting to be able to invest in private markets and invest locally, so that, which has lots of benefits, that we need to have a pipeline of things that can be invested in locally.
Yes,
yeah. So we almost need a, well, project management.
Well, perhaps we'll move on to that in terms of the future, what the future looks like, because obviously local investment is a big thing on the government's agenda, and it's a big thing for the pool's agenda. One dimension of that in the consultation and the feedback that Dorset gave is, not being overwhelmed by the resource that's needed to handle that, because you can imagine that being overwhelming. So perhaps we'll start to talk about pooling now and what the future is going to look like.
Yes.
So when we wrap
Before you
into
do
that,
that, Adrian, will you try to
Actually, my question would be better after we've talked about pooling.
Right. Okay. So LGPS fit for the future. What are the primary opportunities and challenges for Brunel, the company, and the wider partnership from the government's proposals? And then there are a series of sub questions.
Yes, opportunities. So I think they're the sort of the usual ones that we went through actually at the beginning of pooling. So economies of scale, that there will be some fee savings through this, some consistent advice across all 10 if we're doing it, possibly. We can augment that with more UK growth assets if they're available and at the right risk and return. Need to caveat that. Probably need to wait for the devolution deals to go through for some of that to happen. And then overall kind of improved risk management, because actually we're looking over the whole fund as opposed to just the manager bit of it. In terms of challenges, I think as with any new legislation, waiting for the final legislation to go through. And we broadly understand what's going to be in there at the moment from the consultation, but there's always a risk of that slipping or changing between one or the other. So that's a real dependency for us. We've made the assumption that it's going to go through as it was listed in the consultation. That may or may not be true. We will find out. As Steve mentioned, actually, transition of the legacy private markets assets that are left will be costly, probably. We're trying to work through the best way possible, the cheapest way possible to do this. And we're literally just digging into the assets now. I think we've maybe got some councils that don't even know what they've got. So that's kind of interesting. And that's likely an exercise that's going to go on for a while, because we have to work out the most cost-effective way to do this. I don't want to have to go out and hire hordes of people to do this. It seems ridiculous that we do that. And I think finally, the sort of the short timescales that the government has set, recruiting to deliver what they want within those timescales, that's a pretty big transformation from us. We are 70 people at the moment. We're going to add at least 20 more to do what the government has asked us to do. And that's a sort of a best guess. Worst case scenario is bigger than that. And that's a fairly big transformation from us. So we'll be going from a sort of small firm into a medium-sized firm. And that's a fairly big ask in a short amount of time. So those are the kind of challenges I think we're dealing with.
Yeah, that would be quite a big change. Incidentally, as an aside, on the transition of legacy assets, our biggest legacy assets are our direct property portfolio. And we periodically hold meetings with CBRE to manage that direct property portfolio. Who knows when the actual technical legal point of transition will be?
Yeah.
But from my personal point of view, if somebody in your property team wanted to sit in on those meetings and make it a gradual transition,
Happy.
it's not a problem as far as I'm
Well, let them
concerned.
know. Okay, brilliant.
So that they begin to familiarise themselves.
Yeah.
We had some discussions with the property team about how we get to pooling for that direct property portfolio in the past.
Yeah.
Typically, the property, this is before the head of the property team left.
Yes.
The issue has been, well, we haven't got the capacity to kind of, because you've got some very small teams in areas.
Yeah.
One of the questions that that I've mentioned was in terms of in terms of the private market model. At the moment, you effectively outsource, if that's the right word, your investment management, really?
Yes, we're partnerships.
Yeah.
That mean we can pivot if we need to.
Okay.
Yeah.
So to in different areas, like infrastructure versus property versus private equity.
Yeah. Private debt. Yeah.
So you have some outside people. Do you see that model being continuing for the foreseeable future?
You know, it's an interesting question actually, and there's a challenge that's been offered up by the government to us as well. You know, are you going to do internal management here in the future? I think the model that we've got now for the AUM that we've got in private markets, which is about 9 billion, I think, is actually nimble and agile and the most cost-effective model we could have right now. So I think we all know that getting private market staff is very expensive.
Yeah.
It's also quite difficult. We're better off in the southwest because we can get them from London. If you go up north, I understand the sort of National Wealth Fund board is supposed to having difficulty finding good private markets people at the rates that they're paying. So for me, that ability to be able to pivot very quickly into a manager that's got the resources that you need, if you need them, when you need them, and also to have that degree of experience behind you allows us to have a smaller team at Brunel, and I think potentially probably costs us less in the long run. I think if private markets gets any bigger, we might well think about building teams in specific areas, but only when we've business cased it out again and we're really sure that it's going to be good value for money for you guys. Otherwise, I think actually what we've got is super fit for purpose.
Do you think Brunel, you touched on an issue there which effectively raises the question of whether Brunel is big enough? I mean, obviously when the government originally, the previous government was talking about fewer pools, bigger pools, which implies mergers. You know, Brunel isn't the biggest pool.
No.
So do you think that is still an agenda item for the government? And how is Brunel's thinking about that?
I think I'll probably find out tomorrow, but I think we know that high on the government's agenda is consolidation, and whether that's consolidation of LGPS funds or whether it's consolidation of pools. At the moment, they seem to be pushing more towards consolidation of pools, but they haven't really asked for that in the consultation. So that's my sticking point, is I've got 10 shareholders that won't vote for any kind of consolidation unless it's mandated by the government. So personally, it is coming at some point, I think. I don't think we can shy away from that, but I don't know how we will get there unless the government mandates it, because no one's going to do it voluntary at this stage, as far as I can see.
That's a very interesting the point you made there, because I think people perhaps tend to assume that at the end of the day there will be legislation. But what you're saying, you're saying that is the only way forward. If they're relying purely on giving advice or whatever, the people won't follow it.
No, I agree. I think we've all agreed that we wouldn't be averse to taking on some more clients from somewhere else. So we have said openly that we're open for business, so to speak. But at the moment, I'm not seeing anyone wanting to move. So yeah, I think it's a bit of watch this space. I'm not sure we're going to see any movement in the next year or so, but maybe after that, possibly.
I'd like to ask question 3.2, which is that what increase in resources is needed? Because I think you're going to come to the shareholders and ask for more resources in the next 12 months as a result of what's happening in the consultation. And how will you give clients confidence this is resource well spent given past performance?
I'm going to pick you up on that past performance point there, I think. So I think the ask is going to be significant. We've been great at doing a lot with not very much, and we've got a great reputation as a fantastic, professional, passionate small firm. We now need to grow that into a medium firm and take on more risk. And actually, to do that, we need to professionalize a bit more. We need to have more senior people. So I'm not going to lie. What we're going to ask for will be significant, and it's driven by the government's ask. It's not driven by our own. But to do it properly, we're going to have to do that. So I think we've been really great at doing what we've got on a budget, but those days are going, unfortunately. Not what you want to hear, but
if we were speaking part of a larger organisation, it's going to cost us money. Will it actually make any real savings and any real? Are we being forced down a road more bureaucratic, more in that direction, incurring huge expenses potentially at the cost of all 10 of us?
Yeah, we think that the fee savings that we can get by having more scale when we take in the rest of your legacy assets will offset most of that cost, not all of it, but most of it. So, and that's a bit of a rough calculation for us based on the fees that we understand that you're paying at the moment.
Is that an answer for the whole of the clients or just for Dorset?
No, for the whole of the clients. Yeah. Yep. So net, we should be okay. But when we come out with the ask, you'll go, I suspect.
At the risk of being facetious, can we fund it through payments from overperformance in future quarters?
Well, I think I'll respond to that partly actually, which is that, I mean, for me, as we have seen, pooling the impact on our fund and the taxpayer is ultimately through performance, not through fee savings. Yeah. I mean, there have been fee savings, absolutely great, but I mean, they're dwarfed in terms of magnitude by performance. Yeah. So, if it does cost a few more basis points, provided we get performance, but that comes down to our confidence question, which is do we have the confidence or the way that the existing money has been spent that we can generate better performance in the future?
Agree. Yeah. Absolutely.
other areas around pooling in the future.
I imagine in your head you have some idea of what type of infrastructure larger pooling can invest in. I don't know what that would be. Would you be able to give some examples of what type of thing?
Yes, so larger type infrastructure projects that perhaps the pools could come together to invest in. So typically in the UK, we're not great at large infrastructure projects. So, not wishing to name too many, but projects that are more of the size of things like HS2, nuclear, so Sizewell C. Obviously, that will cause a bit of consternation with some people. So those types of large infrastructure have previously not really been available so much to us. And maybe in partnering with the National Wealth Fund as well, that's now up and running, they may be able to take some of the first losses on some of those things. So actually, it makes for a more interesting investment opportunity for all of us.
Instead of requiring Chinese investment in rail infrastructure.
Yeah. It's certainly one of the government's aims. But again, we've got to create a good investable opportunity out of it before we invest. That's the thing. We're not here to provide cash to the government to facilitate their projects. We need to be really clear on that.
Yeah. Just if there were larger pools, let's say going from 10 to 20, does that bring into question the principle that we've got at the moment, that if you change what you do, change your policy, that's got to be agreed by all the 10 members of the pool, all the 10 shareholders. And if one decides not, then it doesn't happen. If you've got 20 or 30, Paul Steve, if you try and get the other 9 interested in the fund that we're invested in, if you've got 29 to get interested in the fund that we're the only ones in, would a larger pool mean that actually you don't have that sort of shareholder embargo on things, that actually just would have to come down to majority decision?
I think it would need to, because you can't make decision by committee at that point. 10 is just about okay, but we've talked about what the problems are with 10 today, all having to agree. If you drop 20 into the mix and still keep the same governance over the top of it, it really won't work. So you have to change that so that more decisions are devolved into the pool. But then that takes away some of your control. So it's a balance to me. Through this whole journey, we've got to make sure that we keep our clients, you guys, our partner funds, with us as partners, because if we don't have a business. That's it at the end of the day for me. So my overriding concern is that everybody comes with us. If we vote for change, we all do it together and we work out the way that benefits all of us. And it has to be a win-win. It can't just be a win on one side, and whether that's Brunel or the government or the partner funds. So it's a tightrope that we're walking, I think, and will be in the future.
Maybe a time to ask the question now. It is a time of great change. Now we're seeing change. You've got a new series of personnel. You've got the government turning around and saying they want to see change in this, that, and the other way, and it's not a given that what the consultation put out is going to be what the end result is. How confident do you feel that you're capable of seeing the end of these changes and seeing it well?
So I think I fall back on a number of principles. One is we're a partnership, and we're a really strong partnership. So throughout the waves of change, and it is going to be a bit of a wobbly period, we stick together and we do what is right for Brunel through this whole period, and our pensions and our members at the end of it, because we can't lose sight of the people whose pensions we are paying at the end of it. Doesn't matter what everybody else wants. That's the really important thing for me. So we make decisions together as long-term investors in the best interests of our members. And I don't think we can go far wrong then if we stick to those principles, and everything else can go on around us, and we have to work out what our tide is, and then we'll surf those waves that come with it. I think that's my best analogy. It's probably not a very good one, but it's the best I can come up with right now. And the other thing that I think I've realised through the last 8 years has just been a huge amount of change anyway. It hasn't stopped. You keep calm and you carry on. And you do what you do, holding your principles very tightly to you. And we are long-term responsible investors at the end of the day. And climate will do what climate wants to do. But if we can do some good in the world with the money that we've got, I feel really good about it, actually, because the work that we're doing is groundbreaking for the industry and really good ultimately for our members. But we are long-term investors. And what we're seeing is some short-term noise.
Yeah, I think that the changes is more than short-term noise, particularly on a governmental scale. I think one of the questions that we have is, will particular pools be subsumed? We're talking about reducing the number of overall pools. That's current thinking. That's my judgment of what's in the air. And what will happen then to the management of all the separate pools? Will they all be coming together, and presumably to affect economies of scale, there will be loss of personnel in certain areas?
Yes, yeah, and I think I would also say at that point, if the pools have to come together, then I don't think they can do that without the LGPS coming together as well.
Yes.
And so that's going to be a mighty lot of change.
Yes, I think there will have to be legislative change, which will affect us particularly, because in order for pools to come together to invest and all those assets under management to see the economies of scale, the decisions which are made by individuals, say on this committee or any other committee in an LGPS, will probably see a change in the way that the committees are formed, and our responsibilities and what we're going to do. So clearly we're going to see a change too. I think that's inevitable.
I agree.
Can I ask for an update on the CIO appointment process?
Yes, so I can't announce it yet, but what I can say is that they've handed in their notice, and we're just working through the logistics of timing of their leaving. So I'm really pleased. So Aidan Dunn actually took part in the interviews for us as shareholder, and it was a unanimous board appointment, which is very rare at Brunel, actually. We don't always all agree. So that was a real positive from my perspective. So worst case scenario, they'll be here by September.
Can you say something about the sort of type of person it is in terms of?
No.
No, what I mean is,
they've got an investment background.
Yes, yeah. They've got a strong investment background.
I mean, obviously, you're going to say that they're going to challenge the investment team, because obviously we want them to challenge the investment team.
Yes, yeah,
yeah. I still remember the first words that David Vickers said to me when he was appointed as the CEO, and you perhaps even you don't know this.
No.
Which was, he said to me something along the lines of, "Gosh, these portfolios have all got an anti-value bias. I hope, if the markets change, that's going to be an issue." And it did change.
Yes.
It caused subsequent performance,
yes.
and he did nothing about it. I mean, he could effectively do nothing about it. Sometimes people are just subsumed into the wave of the corporation.
Yes, yeah. What I will say is that they're very strong at strategic asset allocation. They've got some very firm views on where the market is at the moment. And one of the things that we really liked about them was their sort of strong sense of discipline, particularly with things like when to buy and when to sell. So that's about all I can say.
Okay, that's helpful. There's an important characteristic.
Yes, yeah.
That's good. Follow up. So you mentioned it. So I'm an officer from Dorset Council, so work for Aidan. So and he's told me a little bit about the interview process. So if they're not here till September, what can you say a little about the interim arrangements in terms of who's providing that stewardship? The markets are interesting at the moment, so I suppose with a lack of a CIO, can you say about how the kind of ship is being held steady and some of that discipline around when to buy, when to sell?
Yes. Yeah. I think the board is taking a really strong active role at the moment. in making sure that all of the things that you just mentioned are put into place. We're not waiting for the new CIO to arrive. And actually, I'm the acting CIO, so I get to do the challenge, which is kind of nice because I'm sitting there with two hats on now. So hence the strong degree of challenge over this course of this year, because actually they'll be under me for the best part of this year now. So I think we have got a really strong team underneath. You have met Simon Wood, haven't you? He's been in the listed space. He's got quite a strong discipline, and working with me, we've made a number of changes already, which have been really useful. I think our head of private markets, Richard Fanshawe, is a really strong investor. I have absolutely no worries there. That's forging ahead nicely, and I'm really happy with that. So, and he and I work very well together. So yes, the board did consider an interim appointment. And we thought actually it would probably be more disruptive for the team to have somebody in for 9 months and then go again than actually have me sit over the top of them.
Okay. Is there anything else that you want to?
We're bang on time, actually.
Perfect.
Yeah.
Brilliant.
Thank you very much for coming along today and
Yeah,
for
thank you.
being very good at explaining how you see the world. So thank you.
Thank you.
Right.
You're welcome to stay, by the way. Oh, sorry.
Yeah, go on.
You do next.
You've been to enough of these meetings. You can
It's
tell.
John Beasley and
Yes.
you can stay if you want.
Yeah, I don't mind. I shall stay for a little bit if that's all right.
Yes. So on to the next item. It's Councillor Beasley. You are there. Good.
Good afternoon, Chairman, and good afternoon, committee. I'm sorry I can't be there in person as a member of the committee today, but I hope my online presence will be sufficient. As always, please could you ask me questions, because I may well miss some parts out. I think I'll just start with the Scheme Advisory Board, because that's going to be fairly short, in the sense that the last meeting of the Scheme Advisory Board was in November, and the next meeting is next Monday. So our timing from Dorset's perspective isn't ideal. Although suffice to say, I think that although there are lots of challenges within the Scheme Advisory Board, the predominant one currently is very much around the Fit for the Future and the consultation. And obviously, the board has played a fairly major role in that, given that it is the conduit directly into government and the Pensions Minister. I think we will be learning more about the position on Monday than is in the papers that have been circulated. So I don't want to speculate on that, but I will feed back to our committee here in Dorset, obviously at the next opportunity. If there's anything in between, I may commit that to email, but I'll just have to wait and see where we've got to on it. I think the other thing to say with regard to the Scheme Advisory Board, those who know any of the personnel will know Jo Donnelly, who is the LGA's head of pensions, who is moving on. She will be at the meeting next week, but I was with the chairman. I was one of three who was on the appointments panel for her successor. I can't make that announcement here in this public meeting, but she has got a successor, and we are unanimous in our support for that person. I think that's good for you to hear, because a lot of what's steered through to the department and to the minister from the SAB and back, to pension funds is at really is her priority in her work, and so her successor will be doing something similar. We've got confidence in that successor, and I will report back on that at our next meeting. So moving on to the main part, which is Brunel, and I'll try not to tread on Laura's toes at all. Equally, I hope she won't hold me too strongly to account with anything I've got to say. But one of the key issues, I think, at the last Brunel Oversight Board on Thursday of last week was a presentation and discussion around local investment, and we've heard a little bit about that from Laura today. I think there are some great opportunities there for us. There are also a few challenges, and as Laura has indicated, there is likely to be more cost attached to doing this work, amongst other pieces of work coming towards us as one of the 10 funds in the future. Laura's absolutely right to be raising that at this stage, because I think that is going to be something which will obviously result in some discussion. And I think if we manage this in the right way, the reward and cost ratio that we see between the funds and Brunel, I would hope, is one that we can all end up being satisfied with. But there's, I think, quite a lot of work to do to get to that position. So in terms of the local investment side of things, I believe that we want to make sure that Brunel in and of itself doesn't do more than it needs to do in this, because we'll all be paying for it. But at the same time, we don't want to miss opportunities. I think in the words that Laura used last week, we don't want to be left behind in this agenda. Now, it is driven much more now by the government than it is by the funds, although originally the funds were really at the beginning of this. And we have, I know, through David Wilkes, there have been discussions around what part Dorset might want to play in terms of investment. And I think we'll want to judge that around our fiduciary duties primarily. But we don't want to miss opportunities either if there are investable opportunities to be had. And I suppose also, given the other distractions that are going on, the evolving devolution proposals from the government may have a significant set of implications on this as well. So we need to see more of what's going on there. With the current proposals, of course, devolution in Dorset, if it ended up as the Wessex proposal, with Dorset, Wiltshire and Somerset, are a year further down the road from many others. So we do have a little bit of time to see how that pans out from government. But in the meantime, we want to, I would suggest, take up opportunities if and when we can. So lots of work to do on that. And I know that Cornwall, for example, have done some work on housing. I think we all know that. I've reported on it before. And there are other proposals on the table at the moment. So it shouldn't hold us back. But at the same time, we need to keep a very watchful eye on what's coming towards us through devolution and the other government proposals. Just a little bit on the statistics around transition. You will probably be aware in another report that Brunel, I think, is now 87% transitioned across the 10 funds. Dorset is up in the last quarter from 84 to 85%. So we're just very marginally below. The outliers are still the Environment Agency at 63% and Wiltshire at 69%. And therefore, the remainder are ahead of where we are in Dorset. So we know the reasons why, particularly around property, real estate and the runoff that we have got planned. So that's a transition over time, and also around infrastructure and private markets. And those are ones that mean that we've got more of that than many, which is why we are 85% transitioned and not a higher figure. And I think we're all quite comfortable with that in Dorset, because we don't want to be speeding that up so fast that we lose out as a result of it. We've heard from Laura this afternoon a bit more about the Future Fit plan, and that's going to be occupying a lot of time. And I suspect that the meetings taking place with government, I think Laura said tomorrow, is that correct? Yes, will probably supersede everything we've said this afternoon. But nevertheless, we need to keep a really, really close eye on that going forward. And I think it's inevitable that there is going to be a result of larger but fewer pools over the medium term. And what that actually means in practice is very much down to what the government push for, but also hopefully what notice they take of the consultation that has been undertaken. If they take no notice of it and go ahead on an agenda, there may be unintended consequences, I suspect. I do hope they do take notice, because we've got, I think, in Brunel a really good model, but it's not big enough to suit the government's ambitions. So it is then a question of who comes to join us rather than the other way around. That would be my hope and expectation, because I think it would be a massive distraction for us and therefore for our performance if it was anything else. We'll have to wait and see, but it's absolutely right that pools will be pushed into coming together more than in the past. And it's also the case, I think, that the LGPS needs to come together in more closely and in a more planful way, perhaps, than it had anticipated. And it comes back then to what can the Scheme Advisory Board do to influence that with government, and how can it help not just individual pension funds. Obviously, my heart is in Dorset, but it has to be in my role across all authorities. And how can that also help the pools to enhance what they're already saying through to government? Just a couple of other things to say, I think, in terms of Brunel, it's been mentioned before that we have a newish chair, and it's fair to say that it's early days for Sally Bridgeland and the changes she might bring about. We also in June will have a new chair of the Brunel Oversight Board because Robert Gould has just left the Environment Agency, and so he's stepping down as chair of Brunel. Some of you may remember Robert because he's a former leader of Dorset Council, or Dorset County Council as it then was, and so there will be a new chair to the Oversight Board as well. I doubt that that's going to make a massive difference to the sort of direction and the thrust of the board, but certainly what we've heard this afternoon, I think, with the new chair of Brunel, I think that will make some differences, and I hope we can influence the focus of that. And the final thing I think I wanted to say was that I will have more meat on the bone next week, in the sense that I'm attending the LGC Pensions Conference. It's one of the main 4 or 5 LGPS conferences held during the course of the year. And I think that will be a very interesting agenda, and certainly one where one will get the opportunity to hear from a much wider range of people than perhaps if we just keep it all within talking to people in Brunel and talking to other funds locally. Chairman, that's just a very brief synopsis of what I've been up to. Any questions? Happy to answer.
Thank you very much. Steve.
I've got a question. I just want to clarify, because earlier we talked about larger but fewer pools. And I think I just want to clarify whether John and Laura, is it your interpretation there will be larger but fewer pools? Because I must admit, I may have misread it, but I didn't. And I know that that's been in the air, but I haven't really assumed that was going to be the case. I've really thought it will be the same pools, and for at least for maybe the first step, the next few years. That's whereas there, John, you were talking quite extensively about larger but fewer pools.
Okay, can I answer this? I think probably in 2 ways. The first is, that's my interpretation of everything that I'm hearing, but what any of us hear doesn't necessarily result in that being the outcome. So I can only reflect on what I hear, not just from Brunel, but what I hear elsewhere in the LGPS. And I think it's important to remember that this is work in progress as far as the government's concerned. Go back to what I said about the consultation. I hope that they will listen to what's come back to them rather than have a predetermined position, because if they've got a predetermined position, then I think that's going to be far more disruptive to the LGPS than it perhaps needs to be. But if they're talking about, so we're as Dorset, our AUM's about 4 billion, Brunel 10 times that size, and the government have been talking about pools being much bigger than that. So that implies that there would be fewer pools with more funds within them. That's my interpretation of it. What the timescale is, I think, remains to be seen. Laura may have an opposing view.
And can I ask the same question to Laura? Like, how many pools do you think there will? There are 8 pools today. How many do you think there'll be in 1 or 3 years' time?
I can't speculate on that bit, but what I will say is I think John's absolutely right. Everything we hear from the government is about consolidation. So that doesn't change. I don't know how many pools there will be, but there will be fewer. I think how they get there, though, is a completely different matter, and in what time frame. Because unless they legislate for it, I can't see anybody doing it voluntarily.
Any other questions? No? Thank you very much. Very thorough, as always, John. Thank you. And if you do learn anything useful on Monday, I'm sure you can let us know soon afterwards.
Absolutely, Chair. And after I've been to the LGC conference at the end of next week, similarly, I'll report back on that to the committee anyway, as I would always try to do. But if it's urgent, then I'll try and come through by email in between.
Great. Thank you very much. Okay, moving on then to item 10. David.
Thanks, Chair. David Wilkes, Service Manager for Treasury and Investments at Dorset Council. So I'll briefly summarise the key points relating to the pension funds investments for the quarter. We've got Steve Tyson, our independent investment advisor, here to expand on the economic and market background and how it may impact on our investments. And we also have Tim Dixon from Brunel and Laura Chappell from Brunel here. If there's any questions about Brunel specific performance that perhaps we haven't touched on already through the session. So I think someone mentioned this earlier, but the value of the pension funds assets at the end of December was just over 4 billion, 4.1 billion. The return for the quarter was 1.8% compared to the combined benchmark return of 3.8%. The total return for the year to 31st of December was 10.4% compared to the benchmark return of 12.9%. There's figures in there for the longer periods as well. And the largest driver of returns for the quarter continued to be US equities, and specifically the US mega cap tech stocks, the so-called Magnificent Seven. I think we've started subsequently seeing that unwind to some extent in this quarter. And Steve and Tim maybe might one or other may want to comment on that further. Talked about the replacement for David Vickers, Brunel investment officer who left the company recently. We've also talked about the consultation, government's consultation, and within the pack there is the response that came from Dorset, and that response was shared with committee members shortly after it was submitted. And it was agreed with the chair and vice chair of this committee, and also with Councillor Beasley as the Brunel Oversight Board representative. We've heard comments from Brunel and from Councillor Beasley about what they're hearing about that consultation, but so far nothing formal has come out as a response to that consultation. So we watch with a huge amount of interest to see what happens there. But other than that, there was one thing I just wanted to draw attention to, which was on page 79 of your pack. So under section 2, investment performance summary, we have the regular chart that we have in all the time, which shows those performance figures in a bar chart for the quarter of the year, 3 years and 5 years annualized performances. But we've just added an extra graph this time, which is there to illustrate the cumulative performance of the fund since the last triennial valuation. So as at 31st of March 2022, and what we've tried to plot there is how if you like, the discount rate or the expected return that the actuary used in setting the last funding position, how that would have tracked forward as a straight line over that near 3-year period that we've now reached. But also we've plotted what our combined benchmark would have done against that, and also the actual returns that have come through on there. You can see that there's a large dip at the start of that of the graph, which coincides with the, if you like, the repercussions of the invasion by Russia into Ukraine, and I think a realization that it wasn't going to be a short, sharp conflict. It was going to be a long, extended conflict with significant economies and markets. And then you can see both the benchmark return and the actual returns actually over time gradually coming back towards that discount rate. And you can see that the benchmark return is now, was at the end of December, was above that expected return that the actuary used as a discount rate, but that the actual performance is still lagging that slightly. So I think in a very simplistic way, that indicates, I think, that the strategy that was agreed by the committee 3 years ago has to a large extent been able to deliver, but where we've actually missed out is that the actual returns, and we talked a lot with Brunel today in the training sessions and in the Q&A we had with Laura earlier about how that performance of the actual investments that we've made hasn't met its benchmarks, and that, but hopefully that graph kind of illustrates what impact that has. The note of caution I would say is obviously we're now getting towards the end of March, and the actuary will do their triennial valuation. If the actual return is less than the discount rate as mapped on here, that doesn't automatically mean that the funding position is going to be worse or that the employer contributions are going to deteriorate, because there'll be the large factor that's not included in there is the liabilities, so it has no mention of what's happening with liabilities, but also the actuary, when setting the discount rate for the next triennial valuation, looks at expected returns going forward. So there's a big note of caution with the graph that you maybe shouldn't jump to too many conclusions about what this may or may not mean for the next triennial valuation, but I thought it was quite a good way of illustrating how the fund has performed over the triennial valuation period. I didn't have anything else to say, so before I hand over to Steve, I don't know if there were any questions that people had on that.
Dave, one was to what extent do we well, is it part of, you said we shouldn't jump the gun?
Yeah,
as I was about to,
which you're now about to jump the gun.
That's kind of like 2.2% lag, I think it is, against the discount rate. So is there any sense of what that could mean if that was the 2.2% dip against the cumulative discount rate, in terms of like we talked earlier about contribution rates and stuff, that if our investment strategy means we underperform?
I don't think we can really answer that question, because I do remember there was a similar discussion 3 years ago at a similar point, and at that stage we were being told it's going to be worse, we might have to ask for more money. When the actual detailed analysis was made, it wasn't. And I think that they would be actually would be the first people to say that you can't get complicated answers from these rather simplified graphs. There's a bit more to it than that.
There's a smoothing that. The other thing, if you remember from the training before Christmas, that these actually smooth the returns around the 3 months either side of the valuation point.
Yeah.
So that might, well, that will have an impact.
And that would impact the starting point and the finishing point. So hopefully it gives an. I think what it shows is how important it is that we do hit the discount rate, that we do try. We do bear that in mind when we're making decisions in terms of what investments we make.
Okay, Steve.
My advisor's report this quarter spends a bit more time on performance than usual. And that's the opening section, really, the first page and a half. So Dorset's performance was 1.8% in Q4, but trailed the benchmark return of 3.8% in the fourth quarter. 1 year performance was 10% 10.3 versus 12.9 for the reference benchmark. And then it talks about the environment in which Brunel is investing at the moment, and the main detractors to our performance being the allocations to global sustainable equity, which we heard about this morning, hopefully got some reassurance over, and global high alpha, which lagged the benchmarks by 8.6% and 4.9% respectively over the last year. And then my next point, worryingly, Dorset's 3-year return is 2.8% versus the benchmark 5.5. So that's the lag that we've seen, we sort of see in that graph that we've just looked at. And this is concerning, as we've just discussed, because our objective is to beat the discount rate of 5%, or sorry, of 5%. Over longer periods of 5 and 10 years, our return is better than the discount rate and has beaten 5%. So then we get into a bit of analysis about what do we attribute the poor 3-year return. And then it looks at sort of what's been happening to the underlying asset classes. But at the bottom of that page, I state, I hope it is obvious from reviewing the Brunel fund returns in the Brunel report, in conjunction with where our funds are invested, that this is our Achilles heel, the underlying funds. And we've heard a bit more about that this morning. There's another drag from an asset allocation and implementation point of view, which is that the legacy property portfolio managed by CBRE has had 3-year returns of minus 0.4% and minus 2.2% for the conventional and long lease secure income portfolio, respectively. I don't think that's that different to actually the returns that have been obtained by the Brunel pooled funds, because obviously the past few years has been very difficult for UK property. It's been a poor performing asset class since COVID. And I say there we should return to this topic in separate discussions, because I think we'd like to do something about it. We've tried in the past, but I think we'd like to return to that topic. And I think, David, that will either happen in June or in September. We'll come back to this subject of how do we do property. Could we have done better on our asset allocation over the past 3 years? The perfect portfolio would have had a high weight in passive equities and little in fixed income. And within equities, fewer emerging and fewer small cap equities was preferable from an asset allocation performance. But a strategy reference benchmark of 5.5% over 3 years is acceptable. So then I get into the subject of headwinds. Now we've spent quite a bit of time on this, I think, today with both Laura and with David at the training this morning. So I don't think we need to sort of go over some of those issues again. And then I make the point that Brunel will point out that their performance against peers is acceptable, and certainly that was something that was pointed out this morning, and this is a point fairly made. The whole industry has struggled with active management. It's something for us to reflect on, but my advice is that now is not the time to give up on all active management in favour of market cap passive. For reasons that we've discussed in the past, market cap passive is particularly flawed at the moment. Then I start to talk about the global environment. I started to write this about 2 weeks ago. I had to change it like every time I sent it off to Dave as the draft. I mean, you know, it is dominated by Trump and the deluge of directives. So, I mean, dramatic to say the least. Will have major implications for economic growth, defence spending, diplomacy, energy security, the world order. I wrote, it has surprises many of us that the overall level of markets in this volatile political environment seems fairly calm. Well, I wrote that just before, and sent it off just before what happened in the past couple of weeks. But cracks in confidence are starting to appear as tariffs take effect. I put that extra sentence in just as they were, my draft was starting to be out of date. I think that, I mean, I think it's very difficult to navigate it, and I don't think we need to do anything. You know, my fear is that higher tariff, that these are fundamentally destructive economic policies, that higher tariffs will result in higher inflation and a greater risk of economic recession. I think we've got a diversified, sensible strategic asset allocation. We have to have faith that Brunel and their managers will be able to navigate that environment. So To draw conclusion, I don't think we need to change anything from an asset allocation point of view. I think it's worth noting some things which are very interesting in the markets at the moment. The German index is one of the best performing indices in calendar 2025 this year, against the background of tariffs and anti-European sentiments. The UK market is performing better. I mean, a lot of people have given up on the UK market, pension funds in the UK, as is topical. I think I've said to you previous meetings and previous training, don't give up on the UK market. There have to be opportunities in the UK market, and Brunel are reformulating their UK active portfolio in this spring. The change is coming. We've agreed to that some time ago. It's taken longer than I hoped to sort of actually happen. But I think that's a positive thing, and I think again we have to have faith that their managers will be able to find good investment opportunities in the UK, because I believe that they exist. And the other thing I get into then is really kind of we've talked extensively over several quarters about the Magnificent Seven in the US. I think it's clear now that the period of UX exceptionalism is over. It's in the past. The US has become too dominant to the market. Those particular stocks have become too high a weight to the market. It's created havoc for Brunel, for active managers, for asset allocators. But I think we're at the changing point, and we use that as the part of the rationale for a change that we made last quarter, which was when we deallocated from the Paris Aligned benchmark portfolio to the low volatility portfolio. I think that is proving to be a very wisely timed decision, because I asked a couple of days ago or yesterday for the year-to-date performance, and the low volatility fund this year is only down 1.5% versus a benchmark of -4.3. So it's on a relative basis, it's 3.1% better. Whereas funds like Global Sustainable is down 4.6, Global High Alpha down 4.7. Smaller companies is down 8.4, so that's a kind of a bit of a concern on smaller companies. As we had conviction in last quarter, the volatility is I think it's a good allocation that we've got, and it's tight on a timely basis. And we may come to consider whether we may want to allocate more there in the future when the time's right. In terms of a couple of glimmers of hope, I think on a few of the Brunel portfolios, there's slightly better Q1 performance coming through. I see that on low volatility. I see that Global High Alpha is slightly ahead of the benchmark. The one fund that, and this is just something for Laura to note, that I was a bit surprised about when I saw this figure this morning. We questioned David with it. Is that the Global Sustainable Fund this quarter is down 4.6 versus a 4.7 benchmark. In other words, it's in line with its benchmark. I was quite surprised by that, because my anticipation has been that that's really going to, in this year, it would start to outperform, and in an environment in which the Mag 7 is collapsing, and it isn't. So that's a concern. So that's a little flag for Laura and in her role as acting CIO. The other thing that's a glimmer of, the numbers I talked about earlier on are the 3-year relative numbers for Dorset, the relative performance. It was mentioned earlier, actually, that Q1 of 2022 was a very bad quarter for the markets. And of course, that won't be in the 3-year numbers at the end of this quarter. So that the 3-year quarterly numbers that we're looking at that were very bad will look a little bit better, I think, when we get to the end of this. I'm hoping they'll look a bit better when we get to the end of March. And it's the March to March that coincides with the triennial evaluation, even though they smooth it a bit. Happy to take questions, basically, from anybody.
We've got the valuation underway right now. So we'll see the reports on that in another 3 months. hopefully by the next meeting. Well, we'll have the interim one, the initial ones, won't we?
We'll get an indicative indication
Yeah.
of what the outcome will be, but we won't actually get the final results probably until November, but September they may be sort of draft format.
Yes. Is there going to be merit for us making larger investment decisions ahead of that valuation?
I think if there's anything compelling that we thought we should do, maybe, but I'm not sure. I mean, we've been spending a lot of time today talking about this, that there is anything particularly obvious that we want to do.
And no, I mean, the things that are on my mind are obviously the global sustainable portfolio, which we talked about this morning.
Yes.
Which we heard the arguments born against. The property, I think there are things that can be done within, we need to plan for the future, I think. Things like property, I think, could return as a subject. I mean, I do think about the allocation within, the emerging markets and small companies. Emerging markets, look as if they're bottoming out. So they've started to perform a little bit better. So, I mean, that's interesting, but I'm not proposing anything today or probably even next quarter on that. I think we've got a pretty middle of the road asset allocation.
Yeah.
If you remember, the strategic asset allocation last quarter didn't change anything. That was the kind of surprise in a way. But along the way, like we've just done previous quarter on switching Pacific Paris line to the volatility, there'll be things that are important.
Yes, a little tinkering.
That are like tinkerings with 9% of the fund. Yeah. That was a really good call. I'm pleased we got that one through.
Okay, and so I guess you and David will arrange some training for the next meeting, which I presume if we're going to talk around private markets and property, that might be two thought processes to start with.
Yes, we'll definitely be doing property either at the next June meeting or September meeting. We also like to invite another portfolio manager from Brunel down. So I think the next one that we're looking at is the Global High Alpha, because that's another high one we've got a fairly large commitment to, and performance hasn't been great compared to benchmark over the recent period. So that's something that's on the horizon. So we need to sort of work up a training program for the next 2 or 3 meetings in conjunction with Brunel, and Tim and his team have always been very helpful and accommodating in terms of requests that have come in from us. So yes, we need to sort of firm up the plan. But as always, if individual committee members have topics that they would like us to look at or feel we should be looking at, then please raise those either at the committee or outside of the committee, and we'll see what we can do. What's incredible is that we now have this. I think having the training before every single quarter is almost invaluable now. And yes, usually helps inform decisions that we have in the afternoon. But what's also amazes me is how quickly we can fill the training up, and how difficult it is to get everything in a timely fashion.
And on that footnoting that, there are lots of good things in the consultation about governance, trustee knowledge and understanding, or committee knowledge and understanding, those type of things, which I think the whole industry kind of is supportive of.
Yeah, just for the benefit of all the committee members, our colleagues on the pensions board are required to undertake education throughout the entire year. And I believe that the resource that they use is also available for us if we want to do any further reading in between times.
Yeah, I think Karen or I or one of our teams can probably sort of circulate that. Yeah, thank you, Adrian.
Yeah, just on Steve's report, thank you for that. I appreciate it sort of changes day by day, week by week, some paragraphs a bit. I appreciate your comment that at the moment, what do we do with everything that's going on I'll sort of sit back and in a bad position. But in some ways, it feels sort of a little passive, thinking so much is going on. Should we be doing something? But I guess we're not clear what the direction is in the.
Tell me what the market will be in 2 weeks' time or 2
Exactly,
months' time.
exactly.
Yeah.
So you don't want to be jumping in based on what's just happened in the last, well, let's say last 2 months since the inauguration, and making decisions on that. But I guess in a few months' time, we'll be sort of 4, 5, 6 months into the changes in America, political changes in America. Do you think we might be clearer about what that means longer term to inform sort of where we go, or
Does Trump do long term?
yeah, but no, but then I suppose we need to do long term.
I think another war.
Yeah, I think the issue on the tariff. I mean, obviously everybody knows that he's a deal maker and tariffs on, tariffs off. It's a lot of kind of moronic nonsense, to be quite honest. But it creates uncertainty for business. Basically, that's the problem. And one of the themes in the market has been that the financial markets provide sort of guardrails around madness. So, in other words, if the market we know he watches the markets. If the markets start to go down, then he will reverse his policies. He'll change what he's doing. But there was that comment, I think it was about 2 weekends ago, when he triggered off, when he said, "Oh well, there might be some short-term problems in the market, but I'm not worried about that." Yeah. And that was the markets would suddenly change their mind on. Okay, so maybe he's not too bothered. I still think that if things start to go a little bit pear-shaped, he'll just change his mind again, blame it on somebody else. It's very hard for us as a committee. We don't tend to take what I would call tactical decisions at these meetings, and I don't think we should stop trying to take tactical decisions. They're extremely difficult to implement. Like, let's take 5% off equities and stick it in bonds. We can't do that practically. There's a future world where, this committee decides sort of strategic asset allocation issues, and within Brunel, there are kind of it might not be called dynamic asset allocation, but there might be kind of boundaries within which Brunel can more easily, because they're working at it every day and they're properly resourced, can make changes. We're already in an infinitely better position than we were pre-pooling when we made that change from one fund to another prior to Christmas. David mentioned to me a couple of weeks ago that had we decided to make that change pre-pooling, it might have taken us 6 months or 12 months to implement a change like that. And in the meantime, the market is moving on. But actually, Brunel were able to implement that in kind of, most of it was done before Christmas. We only decided it at the last committee meeting. I've forgotten the date. End of
November.
So most of that was done before Christmas. I mean, that's a kind of a win in terms of how speedily you can make market changes. But it's difficult for us to make kind of tactical changes at committee meetings, on the fly. I wouldn't want to do that particularly.
I think, Steve, can I just add?
Yeah.
I totally agree with you. Now is not the time to be making tactical bets on a really uncertain market. Keep calm, carry on. You're well diversified. You're long-term investors. You've got a good strategy. Let's see how that shakes out a bit, and there may be opportunities later. But I think right at this moment, when we're all in the middle of it and we don't understand what the outcome's going to be yet, whether it's short-term or long-term, I think we need to wait and see for a bit longer. So I think Steve's 100% right.
Anybody else? Okay, thank you very much. Moving on then to the Treasury Management reports. David, you again.
Yeah. Try and be very brief on this. So you don't want to stay for this?
No, You've
got trains to get.
Thank you. See you later.
Thank you for coming in.
Yes, so this report revises the previously approved Treasury Management Strategy for 24-25, which was approved by the committee this time last year. It has no strategic allocation to cash, but it does have a number of cash flows in and out of funds, including member and contributions, pensions and other benefits, property rental income, investments and disinvestments. And just to give an idea of size, contributions into the fund from employers and their, from scheme members and their employers was approximately £160 million a year. And the benefits that go out equal an opposite amount. So we have to manage those cash flows to make sure there's sufficient liquidity to meet the liabilities as they fall due, and to invest temporarily any surplus balances appropriately. Treasury management strategy just provides the framework or the limits within which us as officers can manage those cash flows and so-called treasury investments. So it's what we can do, and it isn't necessarily what we will do. So in some cases, the limits or the counterparties are ones that we wouldn't necessarily use, but it's useful to have them there in case of circumstances meaning that could be beneficial for us. So it's unchanged from the current year, and it broadly follows the Treasury Management Strategy of Dorset Council, the administering authority, where applicable. And in relation to counterparty risks and limits, it continues to be consistent with that of the administering authority. And that's all I really wanted to say on it. So basically looking for approval of that strategy.
Does anybody want to say anything about this?
Just a reflection that we heard back from the audit report that what they regarded as significant was much greater amounts than you're posing in here. Now, I'm not saying that every day you're going to be using up to the limit that we're setting here, but it may be for future that we raise the limits available for the team to use.
Yeah, thank you, Adrian. Yeah, I mean, we've set the limits because we think they are limits that we need,
yes,
with some headroom. So what we don't want is to set the limits so that they're so narrow that actually I need to rush around and get an emergency agreement by the pension fund committee to.
Yes.
So we've allowed enough headroom within those, but it's a good point. At some point,
when you set them next year, when you revise it next year, maybe that there's more needed.
Sure. Okay, can I see those overflow?
Sorry, just a quick question. Obviously, I know at BCP we have our own sort of treasury management arrangements for the council's funds. The pension funds, treasury management and cash flow, that segregated, how managed as a sort of segregated amount from the Dorset Council authorities' own sort of cash balances and treasury management, even if it's got the same or similar sort of treasury management policy. Is it a segregated cash, or is it?
Yes, it is. We have separate bank accounts for the pension fund accounts, and I believe that is a statutory requirement that we do that the money isn't commingled, so it is very clearly identifiable that is pension fund cash for the pension fund, not to be used by Dorset Council. And the pension fund has its own arrangements with other counterparties such as money market funds, etc. So it's all separate money market funds that the pension funds cashes in, as opposed to Dorset Council's main cash balances.
Okay. Can I see all those in favour of adopting the policy? Anybody against? No, it's unanimous. Thank you very much. Then on to item 12. Karen, your pensions administration report. Karen,
Hello. Yes, I am just getting everything to work.
Good.
Hello, everybody. Okay. Hopefully you've all got the report there in front of you. I'll start off with the KPIs as normal. Nothing specific to report there, all looking very good. Hopefully you've got the information there. Before I move on, does anybody have any particular questions on the KPIs?
No, you're all right.
No, okay, super. Moving on to the opt-out data. I've spoken to you before. I know it's been a question raised by the board and the pension fund committee about the people not joining the scheme and having a closer look at who they are. Going back to 2012, the Hutton report estimated that about 75% of people eligible to join the LGPS. It was one of the lowest public sector take-ups when it was looked at that time. How accurate that was, I don't know. We've decided as a fund to look at opt-out data, and we've shared this nationally as well because it's something MHCLG are looking at as well. We engaged with our employers over this a couple of months ago at one of our employer meetings and asked employers if they would be happy to provide us with data. They were all interested and some were happy to help. Not all were obviously able to do so. And we have the data in and we've been able to analyse it. In all, just to let you know, it's not contained in there, but we've got the data for 42 employers. That's out of 170 and about 43% of the membership. So that's the final figure. So it's a good size picture, but it's not the overall picture of the opt-out data. So what we're looking at here is people who have opted out, but also most importantly, people that have not opted in, people that have not decided to join. And we need to understand why that is. If you start work in local government, you will automatically be brought into the pension scheme if you have a contract with hours in it. So most people are therefore brought into the scheme on day one with the right to opt out. But there's also a group of employees with 0 casual hours that have to elect to join. So they are not brought into the scheme on day one of their employment. And that's really relevant to this whole topic and conversation. So there are some people that are brought in automatically and some staff that are not brought in automatically but have the right to join. Looking down there, if I go ahead as sort of headline figures, what's the most important thing that's come out of this is the majority of people not in the scheme are casual staff. So these are staff that were not brought in their employment. They have the right to join. So key questions from this are, do these people know they have the right to join? Has information been passed to them by the employer? Obviously, it's really difficult for people on a casual hour contract because they don't have the same security of income. They're more likely to be lower paid, and they might find that decision to contribute to a pension scheme more tricky for them to make. So this is the group that we were looking at. 3.5 sort of summarises what was good as a positive is 82% of staff eligible to be in the LGPS are in the LGPS. So that's more than the 75% that Lord Hutton mooted in his report back in 2012. So that's a good figure. Of those not in the scheme, 78% of the staff were on casual hour contracts. So, you know, vast majority of those. And of those not in the scheme, just over 75% were female, which again we expect to see in the LGPS as well. The majority of eligible staff not in the scheme earned less than 30,000. And I've attached at Appendix 2 some sort of more detail from the data that we received if you want to have a look at things like pay brackets and age brackets and gender splits, etc. We also identified that some employers have a lower take up than others, and we were interested in this. One type of employer that perhaps has less is schools. So they have a lot of casual contracts. And some of them had more casual contracts than others, and there was a big difference there. So, you know, employers will, you know, for good reason a lot of the time use casual contracts, sometimes not for the best reason, so we have to keep an eye on that. The Employment Rights Bill may address some of this. Some of the employers that fed back to us were town councils, and they have quite a high proportion of casual employees, and you know, you can really understand that. I live in Weymouth, there's a lot of casual holiday staff, and there will be in Dorset, driving around the land train and, you know, working in the busy summer months. So there will be a lot of casual employments in local government, and we can understand that. So I think it probably is a good reflection of the LGPS nationally. I have shared this information. and hopefully some other funds will add into this data pool so that the picture can be confirmed and looked at in more detail. Does anybody have any questions or thoughts they'd like to share on that?
Councillor Brown.
Yeah, just wanted to pick up on that. How does that square with the sort of government's policy about auto enrolment into pensions? Are these people not qualifying under that legislation because they're below 10,000 earnings or below 16 hours or whatever it is? So these people aren't captured by the auto enrolment pensions provisions.
They have to be. There's two things going on here. There's the LGPS regulations and their rules about bringing people in. And that's what I outlined earlier. So under the LGPS rules, putting aside the auto enrolment, these are separate things. Under the LGPS rules, if you've got a contract with hours, you are brought in on day one. Under the LGPS regs, if you on a casual hour contract, you will not be brought in on day one and you have the right to join. What will happen then, as you rightly said, is on top of that, there is the auto enrolment rules. Now that will bring a casual member of staff into the scheme if they hit the earning threshold, which is sort of £900 a month, I think. So if those casual staff earn below that, they will not be brought in under the auto enrolment rules. If they are, then they are brought in then, obviously with the right to opt out.
That's all right.
Does that help at all? Yeah.
Yeah, on point 3.5, the first statistic, 82.23% of staff eligible to be in the LGPS. Is that just the staff eligible that are on casual hour contracts, or is that all staff?
Sorry, Councillor Rice, which section are we looking at? 3.5?
Yeah, the one with the 4 bullet points.
Yeah, so the top 182% of staff eligible, that's looking at, because obviously we've got a picture of all the staff both in and out now. So we've got a picture of, from this group anyway, from these 42 employers, we can see that 82% of people eligible to be in were in. Does that make any sense?
So that includes people on hourly contracts?
Yes, it includes everybody.
Right.
So of those people not in, there will be a mix of people who have contractual hours and who don't. And some have opted out, and some, and I think this is it, because we are looking at opt-out data, but a lot of them haven't opted in order to opt out. So this is crucial to understand how this could happen, because if you just looked at opt-out data, you would think, well, not many people have opted out. But crucially, there's a lot of people that haven't opted in that have the right to opt in.
From those, I'm getting a bit confused with the numbers. So from that data, can you tell how many of the ones that are not automatically opted in, how many of those, what percentage of those are members?
Are members?
How many that are not automatically opted in?
Well, what we've got there in the second bullet point is we know that of those that are not in the scheme that are eligible with contractual hours or without, 78% of them have got casual hour contracts. So that's quite I think the significant thing from this is, and I think if we have a look on the appendix 2, breakdown of contract type, this is of people not in the scheme, 76% casual worker, 2.69 fixed term, and the rest permanent.
Oh, okay, it's in the detail. Okay, fine.
Yeah, there's a little bit more detail there as well.
Okay, thank you.
Okay, any more questions on that? Just to update you, the next item, oh, sorry, was the question. Next item is item 4. A dashboard update, and the update here is to say that we have made the decision not to buy an ISP provision from our current software supplier due to the recent issues that we've experienced, and we spent a lot of time looking at the pros and cons around this, looking at our options, etc., and we have made the decision to go elsewhere. where we feel a little bit more confident. We've used the Norfolk LGPS administration framework, and we're about to appoint an ISP provider this week. We should be able to finalise that, and that means we'll be able to start doing work on connecting to the dashboard, which will be one job done that we're keen to do. Ongoing to that is the work to clean and prepare our data in readiness for the dashboard. It's important to note that although we have to connect by October this year, in actual fact, the dashboard itself won't go live to the public, possibly for another couple of years, but we are required to connect, and that will give us the opportunity to test the dashboard and test our processes and make sure they're in place, but it won't go public for a couple of years yet. In terms of McLeod, we have a mixed picture. We have got some software in and working, enabling us to do most of our business as usual, not all, but most. That means when we do our retirements now, they will be taking fully into account of the McLeod regulations. We haven't got all the business as usual. The significant thing that we haven't got is to do with the rectification. So this is bulk processes that will look back at the picture between 2014 and 2022, which is the rectification period, and enable us to identify any retirement or death benefits or deferments or transfers, whatever it might be, that have been done in that period where people may have had an underpin applied to them. A concern for us is that statutory guidance says that we need to have that work done by 31st of August this year. It is quite likely that for us in Dorset and other Civica clients that's simply not achievable because of the delays in providing the software. So we are working very closely with them, doing all that we can. We're hoping to minimise the impacts to people as much as possible. We're concerned primarily at the moment about getting accurate valuation extracts. The actuaries are already aware that some software suppliers to the LGPS are not going to be providing the right software for every record to be correct. And so it may well be that we have to pay extra for our valuation this year in order for the McLeod remedy to be accounted for in our valuation. So we're doing all that we can and working very closely with our actuaries and our software supplier. We are hoping that annual benefit illustrations will be right going out. The annual benefit illustrations for actives won't be a problem, it's the deferred members. So we will do everything that we can to get everything done. The members that are losing out here are the people that are perhaps due additional money. I think it's worth saying that in the LGPS, this remedy will not impact a lot of people. So we're not talking masses of people going to get a benefit here. It's a lot of work, possibly for a small number of members. But if you think of people who have retired or on receipt of a dependence pension, for example, those are the people that really we want to be doing as quickly as we can. If they're due extra money, they will be paid interest if there's any arrears payable. So we've got delays there, but we are able to move ahead with a lot of areas, but we're not going to make the timescales. I wouldn't have thought, and get the whole job done by the end of August, bearing in mind the other things that we've got this year, such as the valuation, and obviously our annual benefit statements need to go out by the end of August as well. You'll see that there is some data in there of the McLeod members in scope. So we've identified the members on our record that are in scope, and it's worth saying what, because these people are in scope means they could have an underpin. So they could benefit from the McLeod regulations, but they might not. So these are people that we have to run calculations through and identify people. And there will be some areas like transfers, for example, that are going to be a lot of delays with all software suppliers because there are issues with certain types of transfers that are still to be resolved. Okay, so that's McLeod. Does anybody have any questions on McLeod before we go ahead? I expect you're looking forward to the day where we don't talk about McLeod and it's all done.
Yeah,
okay.
Questions there? you want to carry
No
on?
questions? Okay, yep, sorry. Item 6, just to let you know, and this fits in nicely with the information we're saying about the opt-out data. We're going to expand our scheme awareness as much as possible in thinking of what we can do. We've always done presentations to members, that we're just expanding that a little bit and putting more on as standard rather than in response to a request. So we're going to be offering regular new member presentations to all new, and we have noticed that some existing staff come to those, which is a good idea. And we're going to let members know about that through a certain type of correspondence that we send to home address. So when somebody joins the scheme and they're new, they receive a statutory notification, which is a contractual responsibility that we have to send to all new members. And in that, we are highlighting things that people need to know. So, for example, the transfer window and that sort of thing. And we're advertising our new LGPS awareness presentations in that as well. So that's got off to a good start. We're hoping to start a pre-retirement one as well. And this is in addition to the normal ones that we run anyway. So this is one way that we can get hold of people. What we can't do is contact the people we don't know about. Only employers can do that. So we do work very closely with employers and raise these issues and keep them as high priority. The difficulty with LGPS employers is they do have a very difficult job, but also some are far more engaged than others. So it's always going to be difficult with LGPS employers because some are really super and others really struggle. And the final item there is just to keep you, oh no, we've got 2 more items. Employer movements, just to update you with new employers that have come. You'll see they're all to do with outsourced catering from schools. That's very common. And the final one is just to confirm to you that we did submit a response to the inheritance tax consultation, mainly expressing concerns around the need for additional expertise and knowledge, and concern that there might cause delays in payment of death grants as well. And we also included some data to illustrate that death grants paid from the LGPS are not substantial, they're not high amounts. And that was included as well. So we're now awaiting HMRC to come back with the results of that consultation. So that's all from me today. Does anybody have any questions?
Any more questions? Isabel.
After you.
Just to go back to the opt-out data, I understand that there's been very low uptake of the 50/50 portion for pensions. Is that something that we find in Dorset?
It is. Nationally it is low, and I don't really know why that is. If somebody wants to opt out of the scheme, then they have to come to us for an opt-out form, and the staff will let them know about the 50/50 so that they don't have to opt out. And it's at that point where you get some engagement with members that they might go into the 50/50. Ideally, what we would like is employers to advertise that to staff. If people opt out within 3 months or immediately, we don't know about them. And then we know that there is a large number of casual employees that may think, actually, this is too expensive for me. But do they know about the 50/50? So we are reliant here on employers advertising the 50/50. It doesn't have a huge take up. I think they thought initially it would have more of a take up, but it is advertised. We do let people know in newsletters and presentations, and we encourage employers to advertise it as well, but it doesn't have a huge take up.
Thank you, Karen.
Will?
Yeah, thank you, Karen. I think at the last meeting I asked about inequalities of the pension scheme, either people not joining because they earn less money, but also very interested in women, probably less income generation over time, and probably going into old age poverty. So I think I asked one for the risk inequality impact assessment to be updated. It still says not applicable. It does. But also some detail in terms of the people who don't join the scheme. What does it mean for retirement? And those who are in the scheme will probably earn less. What does it mean if you make comparisons with the highest earners and those who earn far less?
Right. So I did come back to you, didn't I, with your questions before. That was to do with the gender pensions gap and some questions. Was that also to do with the equalities impact?
Yes, yes, you did.
Yes, yes, yes.
I was wondering whether we could almost have it as an agenda item where we delve a bit deeper into it, because I'm really interested in
Right.
the equalities section of it. Yeah.
Yeah. Yeah.
So,
Okay. I'm sure it's something we look into, yeah. When we draw up the agenda next time around, we'll make a note of that. Okay, Yeah.
Was there anything else from there that I haven't covered for you?
we could catch up offline if that's okay, Karen. Then we can.
Yeah, absolutely. Yeah,
Yeah.
email me, contact me anytime. That's not a problem.
Thank you.
Thank
Councillor.
you.
I was just looking for Appendix 2 for more details on the opt-in, opt-out data, but I can't find Appendix
No, I
2.
couldn't find it either.
Has it not been published?
It's on our site I used. I couldn't see it.
We can get that circulated afterwards.
Yeah.
I've seen it, it does exist.
Yeah.
I read from it, but I was then like, oh, where are those numbers?
Any final questions for Karen? In which case, thank you very much, Karen.
Thank you.
Really appreciate
Thank
that.
you. Very nice to see you all. Bye-bye.
Bye.
Okay, then moving on to item 13, dates of future meetings as are on paper. So just to let you know. At which point we move to exempt business for some confidential matters. So can we go offline now, please, Catherine?